All right, so we had a little bit of a calm before the storm. Broadcom earnings tonight after the market. So far, not so good. The jobs numbers coming out tomorrow morning. So the market was really small move, had a really small move, not very much volatility, but still relatively elevated. And there are some relatively bearish leaning signals that we have. So we'll talk about what our expectations, what the technical picture looks like going into the jobs numbers, what we kind of expect will happen coming out of them, again, based off of what the market may be anticipating with the technical picture we see here. So we'll break all that down. We'll take a look at what's driving this price action currently this week. A lot of risk aversion this week. I'll show you what I mean and why, and just how bullish some of these patterns are, but not necessarily in all the safety trades. So we'll break that down as well. Obviously, the sector moves. We'll take a look at which sectors are driving the action right now. It's not technology, at least it's not bullish. Technology is not leading a bullish charge right now. In fact, it may be the opposite with how technology has been lagging. So we'll take a look at that. And then our trade idea is actually in that mega cap space. We'll talk about how to trade what has been so bullish, but hasn't been really lately. And we'll talk about how to trade that. So let's go ahead and get started. Today is Thursday, September the 5th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade before the market close. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here with this. Click this thumbs up icon. It opens up this tab. You can click that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the short-term sentiment remains subdued with today's small drop. It was a very small move, a little bit below average on the range, a little bit more range than what we saw yesterday. We only had 49-point range yesterday, 65 today, but still both below the average at 74. That's still a relatively high average, as you'll see here in a minute. But it kept short-term sentiment down. Again, another intermediate confirmation signal. So basically 3 in a row now, 2 with the near-term line down. The near-term line, again, it's not the greatest when the near-term line is in the reversal zone. But again, it's not too deep, and that's the benefit. Like, again, at the lows of the day yesterday, at the lows of the day today, we would have been a lot worse off. In fact, today, the momentum line at the lows was below the 5th percentile, and the near-term line was close. So a move off the lows really kind of helps short-term sentiment end up being a lot less bearish and still keep the odds of a short-term bounce there, right? Especially considering we're back to dark green shading and a green line because the moving average turned higher. We're still above it by 0.5% roughly. So that's still a pretty good move for today. It's not as bad as it could have been. Even with the small range, it could have been worse from a short-term sentiment standpoint. You can see the Nasdaq 100 is the same thing. Now, granted, Nasdaq's a little bit impacted by Broadcom earnings in the after hours, so we're down a little bit more than $1, which is not that big of an issue, as you can see there so far. We'll see how again we might bounce into the morning. But the move before the earnings announcement, you can see just today, again, a very small range below the average with short-term sentiment, again, at relatively bearish levels, but not as bad, again, as it could have been. And, intermediate lines falling still, the market sentiment's falling. The difference here with the Nasdaq and the Russell 2000, for that matter, is that the intermediate line's falling below the reversal zone. The S&P and the Dow, the intermediate line is actually in the reversal zone. So the fact that it's falling is not that big of a problem. And the Dow's short-term sentiment is actually very bullish. I mean, that looks really good for a bounce. But the Russell 2000 and the Nasdaq is something different. The Russell 2000's got the worst short-term sentiment. Like the Nasdaq, has the light pink shading in the red line. and you are a percentage point below the 30-day moving average there. The difference with the Russell is then the NASDAQ is that the intermediate line is actually falling out of bullish territory. So now, I mean, again, any peak of the intermediate line that's below 80 is bearish as it is. But now here we are already falling out of bullish territory with relatively bearish short-term sentiment, more bearish than on the other indexes, and that close to crossing back below market sentiment, which is a bearish signal in and of itself. You can see the near-term line crossed below, and that was bearish, and then the bounce failed to get above it, and bounce, stayed lower. And so now again, anytime these lines are in between the reversal zones, like they both are right now, the orange and the green line, then any crossover of the green line by the blue or any crossover the orange line by the green is either bullish or bearish. In this case, a bearish a decline, a break below would be bearish. So yeah, that's the Russell. The NASDAQ, like I said, we are still above market sentiment, and we're not going to cross over tomorrow. And short-term sentiment's not as bearish, so we did get a more bearish peak here that was well below the intermediate line. But again, considering that this has been a lot more of a bullish index, and considering the S&P 500, like this is a huge part of the S&P 500, a relatively small number of stocks. In fact, all of these stocks right here make up a large percentage of those. You can see Broadcom down about $10 there in the after hours. Not so bad. A couple of clusters on Google. You got some dark green shading on about half of these stocks, light pink shading on the others. So things like Tesla's rebounding, Meta rebounded today. We'll talk about that here later for our trade idea. Amazon rebounded today. Netflix rebounded. So these are some nice, good rebounds, even if necessarily not all of them necessarily are strongly bullish. So, and that's the NASDAQ 100, right? These companies make up a huge percentage of the NASDAQ 100, and the NASDAQ 100, of course, makes up a large percentage of the S&P 500. So, but again, only a 0.5%. So we're still got pretty decent odds that we'll get a short-term bounce going into this jobs, or coming out of the jobs report tomorrow morning. Taking a look at the weekly chart, you can see we have a transition candle for the week. Again, it's not so bad considering that the range is roughly about average, and it's not that big of a bearish candle. We're definitely not crossing below the 10-week yet. We'll get a red arrow when that happens. Now, again, a bearish move tomorrow can increase the range, get that red arrow, and then, now we're looking at a bearish reversal going into next week. But a bounce back up can really keep this transition. The bounce back up could keep this transition, pretty much staying as a transition candle, and set us up for more of another transition candle next week, if not more of a bullish candle. So yes, tomorrow's a really key for that candle in terms of whether or not we're going to actually transition to a new consolidation type move. If I look at the 3 green arrows, we do have 2 reds on the diamonds and the S&P, 3 reds on the Qs and the Russell. But again, they're really close to at least getting a green arrow on the moving average. So that's usually what keeps the 3 red arrow signal from being really temporary. So 3 days, again, 1 or 2 is better. 3 is not the greatest, but we're still so close to reversing that because, basically the market's kind of waiting for this jobs number. Obviously, the 2 red arrows, the MACD histogram is pretty clearly bearish on the S&P and the Qs. And then, of course, they can turn into 3 red arrows tomorrow if things turn south there. If you look at the 2-line version of this chart, you can see we are below the 17-day still. Clearly, the MACD is below its moving average, hence the histogram being red. Stochastics is close to the midpoint of its chart, but we're still holding both the 50 and the 30. Now, you break that 50, like I said, we got more downside. Now, it's not going to be a free fall because there's a lot of support and volume here. But it's not going to get down the same speed as it did on August 5th. But if we break these lines, you would expect we'll retest that low point again. Obviously in a lot slower manner than the first go around. The Qs, if you look at the Qs, they're looking similar. Again, still below the 17-day. MACD now is actually below 0, so a little bit more negative, and the stochastics actually in bearish territory. but still you can see very strong support. As if we were to retest that August 5th low, we have some very strong support there. So it's not going to be a free fall per se if things turn south tomorrow. It'll be more of a a consistent decline instead of a that big shock wave that we saw in early August. If you look at the DMI, again, you can see we're not bearish. In fact, we're not really either. Both lines still below 25. The positive continues to be relatively bearish. So again, setting us up on a little bit more of a bearish bias here from a technical standpoint going into tomorrow. The Qs is bearish, right? We are above 25 and below 20. The ADX is rising, so you can see a little bit more bearishness there. IWM is also showing a little bit more bearish. It's not quite above 25 and not quite yet below 20 on the positive indicator. If you look at the RSI and the CCI, we are below 50 but not below 40. So again, a red box would start here. Well, actually would start from this point where yesterday where we crossed below 50. It would start here, but it only if this drops eventually below 40, and it hasn't yet. We have dropped below 150 on the CCI, so that's a little bit of a concern from a technical standpoint. Of course, we did drop below minus 200 on the here, and we're not quite below 40. So we are showing some bearish signs from a technical standpoint. Again, not as dramatic as what we saw before. But still, you can see again below the green line, but still above the blue, still slightly above the cloud. The bullish trade trend that we had is gone for the most part. It's not quite completely zeros, but for the most part, it's gone. And again, barring a big jump tomorrow, you'll probably have a negative rate of change tomorrow for the S&P. The Qs is below its cloud, a little bit closer to that blue line. We do have a small positive. We're kind of fluctuating on the rate of change. Small positive here. Again, no trend developing at all on the Qs yet, at least. But we are below the cloud. As we get to the pink shading, you want to be above the cloud when you get to the pink shading, not below it, because again, that sets you up for what we're what we're kind of worried about is a correction developing here. S&P, we have a little bit more time till we get to the pink shading, but just a few more days. Next week will be, by the end of next week, we'll be at the, or middle of next week, we'll be at that pink shading. Are we going to be above it or below it? That's going to be above it is really bullish. We can get a good move starting from here if we're above it, starting on the 11th. But if we're below it, then we have a concern, right, about being a new leg lower to the downside. If you look at the Bollinger Bands and the Keltner channels, you'll see that we are in the middle of the bandwidth still, roughly. The bandwidth is dropping like a rock. Those bands are really moving sharply towards each other as that strong bullish momentum that we had is dropping rapidly. The green dots that we've also had this entire time is moving. Again, it turns red when the lines move inside of. So it'll be interesting to see tomorrow if we get a big move, how big of a move will it be enough to halt this decline and keep us, again, a red dots here, which you can see we have continuation patterns in the past, but these continuation patterns are rare. When you get the red dots, it usually means that we're getting a trend change, not necessarily a continuation pattern. So as we get a red dot here, we'll kind of keep our eyes. Again, it's leaning more towards a downside move forthcoming, and not necessarily this bullish move. You also see that in the 4-week range. You can see how, again, we closed a little bit below yesterday's low, lower high, lower low. It would have been better had we closed near the highs above yesterday's low. Not necessarily the case. If you look at the Qs, we pretty much stayed inside of the range of yesterday. If you look at IWM, same thing as the S&P. You kind of closed near the midpoint even. And so if you look at the chart here, again, we talked about that one touch being bearish for the Russell 2000. But if you look at the Qs, you can see we're set up for a bearish move. That's how close we are. That low point's going to start moving up pretty quickly next week. We're going to be a lot closer to a new 4-week low point than a high point. So we're susceptible to that there. And if you look at this chart here where we're sitting inside the 4-week range, you can see we are flirting with the midpoint, like breaking below 50. We're well below the average. So we are. I mean, that's both of these are signs of weaknesses. Now, once you cross below 40, now we're a lot more bearish, but just getting below 50 is a sign, and getting below the moving average is definitely a sign of weakness for these indexes. When you look at, I told you today's range and volume here was a little bit below average on both 44 million and the 6.7 point move. Again, that's a little bit below average, but again, we're kind of setting up for tomorrow, right? And you can see the volume has already dipped back down to pretty darn low levels. These are pretty extremely low. If you recall, the volume here has been relatively high, and we really had this big drop in volume. And just like that, we're back to a pretty significant drop in volume again. You can see the money flow, which is another way to visualize this, is now out of bullish territory and dropping towards the lower half of the chart. Same thing with the Qs, and the same thing with IWM. So, which never did really get nearly as bullish as the S&P 500 did. So, a sharp change in direction for how much money is moving into these indexes. Volatility is the other thing we like to look at. We did close around 20, a little bit below 20 on the daily chart. If you look at the daily chart, you can see that here. So a little bit below 20 there, and right at that 95% mark. Here's the concern, is that the VVIX did not close below 110, right? So we are above 110, and anytime you're above 110, you're susceptible to a big move on volatility. Doesn't mean it has to. We got above 110 over here, and we ended up dropping. You got close to 110 here, and you ended up dropping. But you got to 110 here, and we had that, and then we had August the 1st, then August the 2nd, and August the 5th happened. And so, that's the concern, that the VIX can jump tomorrow, especially considering it's already above its averages. It's already flirting with 20. It's already above the 95% mark. You can see it's already above all these average values it has. So we are susceptible to this kind of move coming out of nowhere again tomorrow if things go really south after this jobs number comes out. All right, now let's take a look at what's driving the price action here. So let me come over to today's chart, September the 5th. And we'll take a look at just a few minutes chart. Those are two safety trades, gold and long-term bonds. Now the dollar was not up. That would be a third one, but still you can see a little bit of a change in direction of sentiment here. Stocks were down; they weren't down that much, only 0.5%. The Qs were up today. S&P, now remember the Qs are down a little bit in the after hours here. But if I go back to the first 3 days of this week, since the weakness started, you can see that bonds are really doing very well over the past 3 days, up 3%. Commodities are down. Remember, they were up a little bit today. The dollar is down a little bit. That hasn't impacted things. And gold was down until today, right? Today it had a good move, and you can see the 3% declines in the Qs. And the Russell, remember, they were down 3% on Tuesday. So really, they're relatively flat going into these last 2 days. But as you can see, like even these last 2 days where we haven't been too bearish, but we've been, skewed to the downside. The dollar's been very bearish, but still you can see just how big a move we've had in bonds and gold. So if I were to take a look here at the, let's take a look at the dollars chart. Again, you can see the reversal, significant move to the downside, which generally means that you're getting some strength. Like, remember how the carry trade was the big deal for the Japanese yen? Well, we're lower now on the yen is higher than it was on August 5th. And we're still nowhere near to retesting those August 5th lows, but obviously you can see we're moving in that direction as the MACD looks, it looks to be potentially reversing back below its moving average. Most likely won't get to a lower low than this, but could make a new leg lower after this little consolidation, this convergence move that we've had, because but only spent 1 day above the 17-day moving average this entire time that it was above. All right, that's a big factor, of course. The dollar versus the euro is another big factor. You can see it's moving up higher, trending to the upside. You can see if I were to go to a longer term chart, we are flirting with getting above the 200-week moving average, which is generally pretty actually bullish for risk appetite. But again, we're in a different scenario now, where we're in a rate cut cycle instead of a rate hike cycle, and that could be have a negative impact if the dollar really starts to weaken globally. Remember, the yen, and for that matter also the franc, are considered safety trades. When the dollar is falling against them, that means the market's really going to safety, and you can see that's the case here with the franc. The franc is at near 5-year highs against the US dollar, and here's where we are in the last 20 years. We're flirting with the credit crisis lows that we had when the US government debt was downgraded, and we're well past the great financial crisis lows that the dollar had against the franc. So very significant strength in the European currencies there. Let's take a look here at bonds. That's the other big mover that we've had so far this week so far, and you can see the 3-day upswing well above moving averages. All the moving averages are rising. If you take a look at the weekly chart, we are moving up there as well, well above moving averages there too, going for the highest close that we've seen in months, right, all year long. The highest close previously was 99.15, so that's kind of what we need to watch for tomorrow. If you look at the market forecast for bonds, obviously dark green shading and a green line after you had a little light pink shading and a little near-term pullback, but maintaining the bullish trend. That's on the daily chart. If you look at the weekly chart, we're just kind of getting started here. The intermediate line is just barely getting to 80. Now it got the 80 before, and we had the cluster, and we failed back here at the end of 2021, going into the rate hike cycle of 2022. Again, different scenario this go around, however, because we're now entering a rate cut cycle, which is typically very bullish for bonds. And that's an important factor when you look at the correlation of bonds to the S&P 500, which again has been positive because the inflationary aspects you can see is back to returning to its negative. Normally it's in a, those two are negatively correlated when we're in a deflationary environment. In other words, when yields are falling, and that is the environment that we are heading towards, right? The markets are not expecting just a cut or two like we had here in 2019 right here, where you just had a few cuts and that was it. It was like this is not a rate cut cycle. It started here in August. That was when we had the first cut, and then by the end of the year we had our last cut. That's what the yields did during the cuts. We're obviously we're most likely going to have a lot more of a decline because the short-term yields are a lot higher than the longer-term versions. Whereas back here when we started these cuts, the short-term yields were actually lower. You can see lower than the longer-term versions were, especially after they got done with those two cuts. Similar to what we saw over here in 2007, where again the short-term yields were higher than the longer-term yields once we started the cut. In fact, once the market started to price in the cuts, and that's kind of what's going on now. As you see, the market is starting to price in the cuts here as the inverted yield curve uninverts. Right, it's still flirting with zero, so we're not clearly uninverted yet. It would take a pretty dramatic drop in the 2-year to really get this uninverted. And the problem is with that is the 2-year is already 130 basis points below the 3-month, which is where the Fed funds rate is, or roughly 150 basis points, but right around 130 or so. So it limits the downside the 2-year can have until the 3-month starts to fall. And again, the only other way that the yield curve uninverts, which is what you want it to do, because that's, again, when this yield curve jumps to high levels, it typically starts really good long-term bull markets. So we want it to get up there so we can have another start to a new long-term bull market. But either that 2 years got to drop even more, and they can't do that until the 3-month drops, or the 10 years is going to start to move higher, despite the cuts, which means the cuts may be inflationary for the market. So something to kind of keep an eye on, to watch to see how this. Remember, the 10-year relative to the 3-month still has a long ways to go. It's 135 basis points. And again, the last time we cut rates was 2019 right here. The yield curve was positive, right? Between these two instruments was positive. And September 2007, you can see it was positive. So this is the kind of first cut cycle where we're starting so negative down here, and have been negative for so long. If you take a look at what's the breadth of the markets here, again, the number of stocks above their 50-day moving average, that's a key sign that we watch for, as well as the new lows. We'll take a look at the new highs. New highs still above the moving average, its moving average, so that's not an issue yet. The new lows are up to 72, but again, 115 is kind of the magic number. That's the 4% mark that really starts. We are above the average, so that's not necessarily the most bullish, but 115 is really when we start to get concerned about more weakness to come, especially when the new highs again drops below its moving average, as it hasn't yet. But the other factor here is the ratio of number of stocks above the 50-day moving average. You can see they've started to drop, and that's not necessarily the best sign, as we have now broken below its moving average, just barely, 336 versus 348, but we are breaking below that. So if you were to break back below 300 now, again, that's a sign that breadth is really deteriorating. We haven't seen it yet today. As you can see, the McClellan oscillator is still, it ended up slightly negative. It was kind of hovering between above and below zero for most of the day, but slightly negative. That's not that big of a breadth problem. We'll see how things turn out tomorrow, but as of right now, that's not too bad. And then if you look at the last thing we like to look at is the new highs minus the new lows, including the NASDAQ composite. Again, we are below the average, but not below zero yet. So 125 versus about 150 or so. That's a sign of weakness, but we don't get bearish until we really drop down. And we'll kind of keep our eyes on the sentiment, which has been so strongly bullish. In fact, the 40-week average of the sentiment here between the AAII bullish and bearish sentiment, the net bullish sentiment here has been, you can see it's higher than it's been in 20 years, right? Going back all the way to the early 2000s. So it's higher than it was in 2021 when we had our correction there. It was higher than it was in 2015 before we started to have that global slowdown, eventually a correction at the end of 2015. It was higher than 2018 when we had that correction that brought sentiment down, and higher than it was in 2011 before we had that correction. So really, and this is the blue line I'm talking about. The 10-week average is the orange line, and we've had other instances where we've been just as bullish and failed, and these are all corrections. All of these peaks here, they're all corrections, and we've had another peak now. But this is the only one that we've stayed up for so long that the blue line has gotten up there. So, once that sentiment shifts to the downside, then we know that, it doesn't necessarily mean that we have to fall immediately, but we're definitely on the cusp, and this will be coming out tomorrow, I believe, tomorrow as well. All right, that brings us to our trade idea of the day. I want to take a look at Facebook. Facebook Meta has been bullish, but as you notice, has been really sideways for now multiple months since peaking here earlier in this year. And that's kind of how it is now. We're kind of fluctuating between a soft bullish trend, and bullish posture, but not really strongly bullish. Short-term sentiment, you can see, is bouncing, but not really strongly bullish there either. And you can see the very small ranges, very neutral Hakinyashi candles there. If you look at the 3 green arrow chart, we've been fluctuating with a lot of arrows here, and we've got 2 red arrows, but it doesn't look like we're really threatening a trend right now. As you see on the 2-line version of this, we're kind of like there's a big volume node that's building up that will become the point of control as a lot of this comes off here in the next week or so. All these moving averages converging above a rising 200 days, so that's good. But they're all really converging on each other right around that volume node. Again, not no earnings yet, and not until after the October expiration. If you look at some of these other oscillators, you'll see a lot of really neutral signals. Both the DMI, directional indexes on the DMI are both below 25. The RSI and the CCI you can see are between 40 and 60 up here, and between the hundreds there. So neutral levels on both of those. If you take a look at the Ichimoku cloud, we do not have any kind of trend going at all. We had a bullish trend, it ended. We have a positive rate of change. We're leaning slightly bullish, but just slightly bullish. And then if you look at the Bollinger Bands and the bandwidth has really been coming down. The bands are now inside the Keltner channels. As you see, there might be a little bit of a shift, but it doesn't look too bearish as you saw in a lot of the indicators. So what I decided to do then was to say, okay, let's take a look at doing an iron condor spread. So selling the low 20 delta on this side, selling the low 20 delta on that side, buying one strike away, and it's at being $5 wide. And you can see where the break evens are. You saw that here on the chart. In fact, the break evens end up being outside of the bandwidth. The bandwidth now and the Keltner channels are completely inside my break even. So we'd have to really have a directional move out of here for us to close one of these sides of our condor. All right, well, that is it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.